This will probably be one of, if not my longest video, but I think it is the most important because it can set you up for life. So, um, I'm going to be going through everything that I've learned about trading, from prop firms to accounts to make to tools to use to indicators to strategy. Literally everything that I know about trading in this one video. Pretty much no edits. And yeah, so let's get into it. So, first thing, tools slash websites that you're going to want to use. TradingView to mark up the charts. Every single trader has it. If you don't have it, then you're a loaf of bread. Second one is a brokerage. NinjaTrader, Tradeovate, HeroFX, which is the one that I use. There's a ton of other ones out there that you can use. HeroFX or NinjaTrader or Tradeovate are the ones that I highly recommend using. I personally use HeroFX. That was just the first one that I heard of, and I signed up for it, and it's a good broker. But yeah, Tradeovate and NinjaTrader I've heard are pretty good. Prop firms. There are so many more out there. Top Step, Alpha Futures, Apex Funded Futures, My Funded Futures, Funded Next, and a ton more. You could probably look them up. Some of them have activation fees, which basically mean once you pass an account, then you have to pay a fee to actually trade it. So what a funded account is when you get good enough at trading, you can sign up for an account, right? You buy an account, and they basically test you to see how good you are, and if you're good enough, then they provide you with live capital to trade with, right? So if I go on Top Step, right, then they have certain requirements that you have to meet, right? Like, you can't lose more than $2,000. The profit goal is, I think, $3,000 or $4,000. 40% consistency rule, no trading on news, and all of that. They have an activation fee. They just came out with a plan with no activation fee, but it's low-key buns. And there are just different prop firms have different rules, so look at the rules for each prop firm and decide which one's best for you. I've heard that Apex is the worst one, so I'm gonna say that that is the worst prop firm. Top Step is a good platform. They've been around the longest and they're the most trustworthy. So if you're looking for a trustworthy funded, then that's the place to go. My Funded Futures is also a good one. Funded Next is good. What is it called? Trade. Let me see what it's called. Hold on. It's like trade something. Trade Advisor. No. Alpha Futures. It's like trade. It's trade something, but that's a good funded to use as well. Um, and then once you pass those, some of them have an activation fee, some of them don't. So if you pass a funded account, then you may have to pay an activation fee, and the activation fee is just that way you can start trading with live capital, and some of them don't. You can just get funded straight away. Live accounts, essentially, you sign up for one, you verify your identity, you put however much money you want into it, and you can trade with that amount of money. There are no rules or limitations to it. You just trade with your own capital. Other than that, there is a lot of things that you need to consider, whether you are a swing trader, scalper, day trader. Scalper, holding trades for a few seconds to a few minutes. Day trader, holding trades for a few seconds to a few minutes to a few hours to a complete day. And swing trader, holding your trade for hours to days to months to years. So decide which one you want to be. There's different strategies for each of them, and there's different ways to trade each of them. What else? I'm trying to make up a checklist in my head. But I just really want to make this video because I do believe that it's important. What is this scene? Oh, that's what that scene is. So So yeah, those are kind of what a prop firm is, what a live account is, and yeah, I went over which ones are funded and which ones for live. Pairs are basically what you trade, right? So if you're trading Apple or Tesla, which I personally don't trade and I don't recommend unless you're like an investor, but if you're a day trader like me, I recommend futures or forex. That's what every day trader recommends. I personally trade GBP USD, Euro USD, NQ, and ES. Those are the four that I trade. That's what I recommend for anyone who's just starting, but that's just me. And yeah, that's pretty much all the programs and tools that you can use. So I'm just going to kind of go over what I think of everything as far as indicators go. If indicators are helping you mark out the charts, then that's cool. If they're giving you buy and sell signals, then that's not, right? If you have an indicator that marks out fair value gaps for you that you can't see or that you maybe miss, that's a good thing. If you have a indicator like kill zones are very important. I have that indicator for myself, and then I have ICT. I believe it's like ICT power of 3 candle, where it shows me what the hourly candle is looking like next to, if I'm on a 5-minute chart. That's another good one. But if you're having an indicator that kind of gives a trend line and says buy here, no, don't use that. Don't use that. Don't use Bollinger Bars to try to help you. Don't use freaking VWAP to try to help you. VWAP can help you, but if you're using VWAP as a buy or sell signal, if price is below the VWAP and you say, oh, it's below the VWAP, I need to sell. No, don't do that. Use the VWAP to help you, to help give you context behind everything, but don't use that for buy and sell signals. Alright, I had to cut right there because my mom called. But indicators, I hate when people use crazy amounts of indicators because they really don't help you that much. And as far as buying and sell signals going, you will be unprofitable. I'm telling you right now, if you use indicators for buy and sell signals, you will be forever unprofitable. Just telling you that right now. If you're using them to help you mark out stuff like session highs and lows, previous day highs and lows, kill zones, fair value gaps, order blocks, for anything like that, that's good. That's fine, right? That helps with context behind taking the actual trade, but you need to use your actual brain to be able to take a trade. That's indicators, that's funded accounts, that's live accounts. So now I'm just going to be kind of showing you how I trade and everything like that. So if you guys need to rewatch this video a few times, then that's completely fine. I know I went through this kind of fast, going through different fundeds and live and the differences between them. So if you guys do need to go back, then that is completely fine. But yeah, this is pissing me off. There we go. But yeah, so I'm just gonna kind of show you guys what everything is. So yeah, if you guys, I'm just gonna be kind of going from the complete basics. So I'll probably be done basics. I consider is up into an up or down trend. If you guys already do know the basics, then you guys can go ahead and skip to wherever it sounds like I'm talking about stuff other than the basics. Ignore this. I'm not unprofitable, I promise. It's because I was testing a strategy out and it low-key sucked. So I'm just gonna go to this chart and show you what everything is. I'm gonna try to use the live chart as an example because without it you can't really learn anything. So when you come in here, it's probably going to have either a white background with black or with red and green candles, or a black background with red and green candles. If you have those, you are a loaf of bread, and you either are an unprofitable trader or you are a new trader. These chart colors are insane. I love them so much. A lot of bottom and top tickers use these. I'm not a bottom and top ticker, but it just looks really, really clean. So, with that being said, let's kind of go over, this is a backtesting platform, this is not the real market. Yeah, I will load up TradingView though. So basically what kill zones are is there are certain sessions in trading, right? Sessions are the best times to trade, right? So New York AM is the best session, if not London, but I personally think New York is the best session to trade. That is where the most volatility comes in, and it's just overall the best one to use. Um, the next is the London. That's pretty good. It has a decent amount of volatility, but unless you want to stay up late, if you're in the US, I would not recommend trading it. And Asia, everyone hates Asia, but it can low-key be an insane session. It just depends on your trading style, how you trade, what pairs you trade, and so on. So, for me personally, I trade Asia myself because with going to school, it doesn't really allow me to trade New York AM. Um, so yeah, I trade Asia, which is fine because my strategy still works in Asia. My strategy works for every session and pretty much every forex and futures pair. Tasty Trade is another broker. Um, but if you go onto TradingView, right, if you want to execute trades on TradingView, then this is where you would go. You would see the brokers list. This is all of the brokers that they have. And some of these I've mentioned, and some of them I haven't. Tasty Trade I mentioned, Ninja Trader I mentioned, Trade of 8 I mentioned, but all of these are just brokers that you can use, and there are more brokers. Obviously, all of these are brokers. There's just a ton of brokers out there. It just depends on what you want, how much you have to invest into yourself. It literally just all depends. So, yeah. So, I went over kill zones. These are the indicators that I have personally, and these are my settings. I am in California, so my time frame will probably be a little bit different than yours. And then the PO3, this is my settings for that. Yeah. And then basically what the PO3 candle is, right, I'm on the 1 minute chart. This is a 1 hour candle, right? So if you go to the 1 hour, then it shows the high, the low, and so on. So yeah, you can use that to help you with trades. But yeah, these are time frames. These are where you can execute trades or mark up the charts. I personally, I don't use 1 month. 1 week, 1 day, 4 hour, 1 hour, 15 minutes, 5 minutes, 3 minutes, 1 minute. Those are most of the time frames that people use. So yeah. So we went over that, and yeah, so these are pairs. These are all the pairs that I trade. I don't really trade Bitcoin USD. I don't really trade Bitcoin. But if I want to look at an active chart for some reason, if I'm getting an edge, then I'll go to this. These are where your tools are. These are things that you can use to help you chart up and make you want to take a trade, right? So if you want to mark out, this fair value gap right here, that you can use the rectangle tool, which is this, and you can kind of just go like that. You can customize it as well, right? By default, this will all be purple, but you can customize these things too, right? Like these are your crosshairs. You can use this, and oh, I don't like that. Why does ICT use that? I don't know. These are your lines. I don't know what half of this stuff are, because you really don't need half of this stuff unless you are trading like Apple and stuff. Which, to be honest, most of those guys are just gurus, and yeah, there's just not. I would not recommend listening to them. But vertical line, you can mark out, other sessions and stuff. You can customize all of these. I personally use horizontal array, the box, long position, short position, all of that. What are my settings for this? The white at 14. You can pretty much change your settings for like literally any of these, which is like the best thing about this. What do I use for this? Third one at 35%. Or wait. Third one at 35%. Alright, cool. So yeah, you have short position and you have long position. and then you have a box, and then you have a horizontal array. You can change the colors for any of these. You have a trend line, which I use for market SMTs. You have the fib, which is one of the most important things for me in my strategy personally. You have the weighted volume average, right? So if you want to take a certain time, then you can see kind of where the volume is. And this would be an important key level, which I should probably be using that more often, but it's whatever. The gun box, you can mark out OTE and equilibrium with that. You can use the path to, decide where you want your trade to go. You can use this to kind of circle things for demonstration, and then this is like a circled fib. I never use this one, but there are strategies that my friend has shown me that works with that tool. But yeah, so you can find all of this here. I personally just favorite the ones that I use the most. That way I can just, click them from here. But if you want to do it from here, you can too. I never use this one right here. I pretty much just use this one, this one, this one, and this one. And that's pretty much all I use. So it can go there. And then if you want like the double charts like I have here, these are for 2 pairs. This is the spot SMTs, which we'll go over later in the video, obviously. But you need TradingView Premium for some of this, which I don't have TradingView Premium. I just don't really see the need for it. Like, I can easily just swap between both of these. So, yeah. Which I can already spot an SMT, which the SMT is right here. Which I'll just go over what SMT is right now, because why not? An SMT is when a low, well, I can't really explain an SMT. Okay, so this is what we're going to do. We're going to go over candles first, and then kind of get into everything else after that. A candle is these things right here, right? The big, fat candle. Like, I don't really know how else to explain it, right? Like, this is a candlestick right here. Oh my gosh, this is being annoying. Okay, it's fine. This is a candle right here. Right? This part right here is the body or the candle. It's that. The wick is this. This represents the lowest or the highest point that price went. The candle represents the price, right? So this means, right, price went all the way down here at one point. Okay, this is being annoying. This means that price went all the way down here at one point, and this wick means that price went all the way up here at one point. This right here is the if it's an up candle or a bullish. If it's green or up, it's a bullish. If it's red or down, it's a bearish candle. Right? So if it's a bullish candle, then you have a low open and a high close. If it's a bearish candle, you have a high open and a low close, right? So if assuming this is a bearish, right? This right here, where is it? This right here is a high open, right? Which is the opening price for this candle. And then low close, which is where price closed at for that candle, right? Price went all the way up there, and it also went all the way down there, but it closed right here, and it opened right here. So, that's kind of what a candle is, and what a wick is. And, again, an up candle is bullish, a down candle is bearish. Please engrave that into your brain. If you're betting on price going higher, you're longing it. If you're betting on price going shorter, it's called a short. Engrave that into your brain. Engrave everything that I'm telling you into your brain, because it's all important. And I'm not trying to give you an information overload, because I had that at one point. I still kind of do, but I know how to organize it better. Okay. Someone in my neighborhood is just blasting music. So yeah, that's what a candle is. An uptrend is kind of what it sounds like. It's a trend, right? You know what a trend is. It's a trend going up, right? So, right? And a lot of times you can use your line to kind of establish a trend, right? Price is bouncing off this line, therefore it's a downtrend, right? Price is let's see, price is going up right here, right? It's going all the way up. You know, that means we're in an uptrend, right? So when price is going up, when it's clear that's going up, it's an uptrend, and when it's clear that's going down like it is here, then it's a downtrend, right? So downtrend, uptrend, downtrend. Now we're probably going to go up because this created a lower or a higher low, right? So I establish candles. Now this is the part to not get mixed up. The high of the candle does not mean that it's a high, right? Notice how there's two bearish candles here, right? This is my bullish candle if you guys didn't know. These are this is four straight bearish candles. These are four straight down candles, right? Just because this candle right here, the highest point of it was here, does not mean that that is a high. A high is when you see an up candle and then a down candle, and it's the highest point of those two. So a high and a low always consists of two candles, right? For example, let's say we're using these two right here. So we're using these two right here, right? A high, we have an up candle or a bullish candle, and we have a down candle or a bearish candle. This right here is the highest point of those candles, okay? A low is kind of the same thing, but it's basically the opposite, right? It's a down candle and then an up candle and then the lowest point of those two, right? So here we have a down candle and then we have an up candle. The lowest point of that is actually right here, right? So that is a low, right? That's a low and that's a high, okay? So when price, let me try to find an example. So for example, we see a high right here, right? Because an up and a down, highest point of that. We see a high that gets broken. It's a break of structure, right? Because there's structure right here that's signaling a downtrend. And then what does the price do? It breaks the structure, it breaks that high, and then what does price do? It rallies, okay? See? Right? And when price breaks this low right here, breaking structure, what does price do? It goes down, right? And what does it do? Price goes up a little bit, and then it just breaks structure, so now it's probably going to go down, right? Let me delete all this, right? So, up, a high, a low, downtrend, uptrend. That's pretty much it for basics. I'm not really too sure what else to go over. We went over fundeds, lives, tools, platforms, what a candle is, what wicks are, what a low is, what a high is, what an uptrend, what a downtrend is. So yeah, I'm going to go into the confluences now. By the way, if you don't get any of this and you keep on watching it over and over and over again and you still cannot get it, please watch TJR's bootcamp. TJR, he's straight, but he has a strange personality. Love the man, TJR. If you ever watch this, I mean ever, love you, bro. But please go watch TJR. He literally explains the basics so well. He's how I learned the basics myself. A lot of people hate on him. I don't know why. He's a multi-million-dollar trader, and he's just good at trading. And so, yeah, please, if you don't understand it how I'm saying it, please go watch TJR. Watch his bootcamp. If you don't understand me, you will understand him. I promise you. Anyways, so we are going to go with the basics of... Actually, I'm going to go over the importance of time frames, right? A higher time frame is more important, right? So 1 minute, most, like, lower time frame, like, anything from 5 minute or below is, like, pretty much lower time frame. That's where you, like, pretty much want to make your final confluences and executions, right? 15 minutes and up are, like, higher time frames. That's where everything gets charted. Those are the most important things, right? So, for example, right, a 1 hour fair value gap, right, which is right here, which price just inversed, which means we're probably going to be taking out this liquidity up here, which actually I might take a trade on that pretty soon. Right. So a 1 hour fair value gap, right, compared to a 1 minute fair value gap. A 1 minute fair value gap has a much better chance of being disrespected than a 1 hour does, right? So for example, right, if this was a 1 hour, this would probably get respected. But since we're on the 1 minute, what does price do? It just absolutely rails through it. Okay? The higher the time frame, the more important / more power it has. That's like pretty much all you need to know, right? So a 1 hour fair value gap is going to have a much better chance of being respected than a 1 minute fair value gap has. A fair value gap, let's go over what a fair value gap is now. A fair value gap is a 3 candle sequence. It's always a 3 candle sequence, nothing more, nothing less. Okay? A fair value gap is it's a gap in value, basically. I don't really, know how else to explain it, really. It's a gap in value. It's basically space, but it's basically the space between the 3 candles, right? So, say you have 3 candles here, right? Basically, what a fair value gap is it's literally just the space between the candles, right? So if these are your wicks, if these are your candles, right, and these are all, green, okay, the middle, and if you're looking for fair value gaps, the middle one is the most important. Well, all these are pretty important, but the wicks are the most important part of spotting fair value gaps. Okay, so a fair value gap is literally, you see the space between here? That's a fair value gap. That's an imbalance in price action, right? If the wicks were all the way down here, this wouldn't be a fair value gap. But if the wicks are up here, like they are right now, you can this right here, that space right there, is a fair value gap. Right there, that's a fair value gap. It's a 3 candle sequence. A wick, it's when the 2 outside wicks are not overlapping. The 2 outside wicks are not overlapping. The middle wick, the outside wick, the wicks are not overlapping. That is a fair value gap right there. Price can either disrespect it and go right through it, or in that case we'd probably be taking a short, right, because price is obviously going up, or it can respect it and come to the CE or OTE, which CE is the middle of the fair value gap, right? So that line right there that I have is the middle, and then the OTE is basically just the 50% mark of that 50%, right? So this is the 50%. OTE would probably be around right here, right? OTE stands for optimal trade entry, by the way. So CE is stands for consequent encroachment, and OTE stands for optimal trade entry, right? Fair value gap right here, CE where that white line is, OTE around right here. This is what you use the fib for, okay? The 0.705 right here, that's prime OTE. 0.79, a little bit pretty good OTE. 0.62, pretty good OTE. 0.5 is equilibrium. That's where price rebalances. That's like a balance between premium and discount, right? Everything above OTE will always be pretty much above, will pretty much always be premium, right? Any, like, right here, or like right here and below, this is like regular price, right? This is discounted price, I should say. This is discounted price. This area up here is the premium price. This right here, this line right here in the middle, is where they meet in the middle. Price will often revisit that and then continue in whichever direction it was going. So, with that being said, price, right, so if this is our fair value gap, price can either come down in here, respect it, and then continue going up, or it can disrespect it and just keep going straight through it, in that case you would want to probably take a trade in the opposite direction. Depends on your context. That's a fair value gap, right? So let's do a live example, right? So right here, what do we have? We have 3 candles. 1, 2, 3. What are the wicks? Are the wicks overlapping on the outside candles? This is the outside candle. This is the outside candle. The wick is right here for this one. The wick is right here for this one. So where's the fair value gap? The fair value gap is right here. That's the fair value gap. What does price do? It inverts it, right? So we can probably assume, I don't have much context, so I don't know if this will win or lose or not, but we could probably assume, right, that price will go up to this high right here, which I need to invert these chart colors, because these are not right. That's what, 1 at 14, and then this is supposed to be red at like 20. There you go. So we can probably assume that price will go up to here. Liquidity is the most important thing in trading. Liquidity, basically, in the most simple terms that I can put it, is the space above the highs or below the lows. So, right, a high is right here, is formed right here, right? This is the high. This, right here, I'm going to circle the liquidity. That's the liquidity, right there. It's the area above the highs and below the lows, right? So price will probably go into this zone right here and continue down. A liquidity sweep is when price takes that out and it goes lower. So, what did, let me try to find a good liquidity sweep. What did price do right here, right? This is, this is a low, a down candle, then an up candle. All of this is liquidity. What does price do? It comes down and it takes this out, right? This wick, meaning it takes it out. And what does it do? It continues to go higher. Liquidity sweeps are the most fundamental and most important thing in trading, right? What do we see right here? A high, get taken out. What does price do? It rallies lower, okay? That's what liquidity is. That is the most important thing in trading. So now we've went over fair value gaps, and liquidity. An inverse fair value gap is exactly what it sounds like. It's the inverse of a fair value gap, right? A fair value gap is right here. An inverse is when the candle body closes above the fair value gap zone, right? So this is the top. This right here is the top of the fair value gap zone. What did the candle do? It closed above it, right? Price closed right here, and the top of the fair value gap zone is right here, right? So this is an inverse. This candle right here is the inverse fair value gap. Okay. Now let's go into order blocks, because order blocks are pretty important too. And my mom is calling me again. Okay, so I do have to go out to dinner with my mom, but I promise you I will be right back, and we will go into order blocks. Actually, I'm just gonna do order blocks right now, really fast. Okay. See all of these down candles? See how many down candles there are? It's a major move down. It's a major move down. An order block is this. It's literally the move up before the move down, or the move down before the move up. Okay, right? We have a move up and then a major move down. Right here, this is the order block. That's an order block. Okay, now I gotta go. But I will see you guys later. Alright, we are back. And I mean just got back like 30 seconds ago. But where was I? We just finished order blocks. So I'll try to draw an example out for you, right? Okay, so let's say an uptrend, right, and then price comes down. Oh, let's say this here. Let's just say this. Ready? We go down, and then we go up one more time, and then we go down like this. Right? So we're going down, and then the move up before the move down. So this would be our order block, if that makes more sense to you guys. right? So let me see. Again, we can go, like, what do we see right here? We see major move up, the move down before the move up, this block right here, this block right here. That's our order block, right? And then what does price do? Goes back down on the order block, respects it, goes back up, right? So that's what an order block is. So now we've gone over fair value gaps, an inverse fair value gap, and an order block. That's kind of all the stuff that you need in liquidity. That's kind of all the stuff that I use mainly. Let me go to my notes and see what, okay, SMT. So we'll do SMT. Okay, so I'm gonna use FX replay for this. Okay, so you see how, let me find a good example. Are we on the, let's go, let me go to the 5-minute on this. Okay, so let me see if I can find one on here. Okay, so here's one. Okay, so what do we have right here? We have a high. This is actually technically the high. We have a high right there, and then we have another high right here. Okay, these are two corresponding pairs. Corresponding means they basically move the same, right? This goes up, down, or down, up, down, up, down, up, down, down, up, down, up, down, up, down, right? They move the same. One pair, right, can show you what the other pair will do. And, okay, yeah. Okay, sorry about that. Okay, so these are two corresponding pairs, right? So they move the same, and then one can be delayed, which means if this is going, where's my path, right? If one pair is going up like this, right? But then it starts going down, okay? And then the other pair is going up, right? And it just keeps going up like this. Then we can assume that because this pair went down right here, that this pair is going to go down as well, right? So that's what SMTs are kind of used for, is to try to spot when that will happen, right? So we have two highs right here, right? And then this is the same high. These are the same two highs as this one. The only difference is this high right here. Let me go to my, is this high right here. Let me change the color of this really quick. Is this high right here took out this high right here, but this high right here did not take out this high. Oh my gosh, can it stop being annoying? Did not take out this high. Right here, okay? That is what you call an SMT. Okay, is when one correlated pair takes out a high and one doesn't. And the pairs have to be correlated. This is why we use NAS and ES, okay? So this right here would be the SMT. Two of the same highs, and one high takes out the other high, and one doesn't. It's the same thing for a low. It's the same thing for a low, right? Let me remove the drawings on here. Okay, so let me... Okay, so this is another one, right? This is the same. These three lows are the same as these three lows. The only difference is that each of these is that this low right here takes out this low, but this low does not take out this low. That is an SMT, right? SMT right here, SMT right here, and notice that every time there was an SMT, what did price do? It rallied back up, right? The SMT right here, it kept on rallying down, right? So that is what an SMT is. Again, if you don't understand these concepts, go watch TJR, because I can't really explain them any easier. So we've gone over an inverse fair value gap and a fair value gap, SMTs. We've gone over sweeps. We've gone over order blocks. Breaker blocks is a low, a high, a lower low, and then a higher high. That's pretty much it. It's hard for me to explain them, so for this one, I would recommend going to watch TJR's video on this. But it's a high, it's a low, high, a lower low, and a higher high, right? And then it goes down, right? So this would be the order block right here, or the breaker block. That's a breaker block. An order block is this. Hold on. An order block. Oh my gosh. An order block is the move up or down before the move up before the major move down, or the move down before the major move up. A breaker block is a low, a high, a lower low, and a higher high. So that's what a breaker and an order block is. Now we can go over what retests are. Think of it as like you're taking a retake test in school, right? Like if you fail a test, then you retake the test, right? So like a fair value gap, an order block and a fair value gap, rejection blocks are all things that can be retested. And, a rejection block, order block, breaker block, fair value gap, BPR, which stands for balanced price range, which actually there's one right here. It's when there are two overlapping fair value gaps, right? So there's a fair value gap right there, and then there's also a fair value gap right here, right? And then this area right here is overlapping fair value gaps, so that's a BPR, balanced price range. Right, so what price does is most of the time, if there's a fair value gap, it'll revisit the fair value gap and then continue up like it does here. That's called a retest, okay? So another thing to note is that when there are multiple fair value gaps lined up like this, is that in order for this move to be invalidated, because notice right here, right, there's an inverse fair value gap, but if you would have entered off that, then you would have gotten stopped out. Why? Because when there are overlapping fair value gaps like this, in order for that move to be invalidated, the last fair value gap has to be inversed, right? So if this one gets inversed, it doesn't matter. If this one gets inversed, it doesn't matter. If this one gets inversed, hold on. If this fair value gap gets inversed, that's when the move is invalidated. Why? Because it's the bottom of the fair value gap. Same thing for this, right? If there are multiple bearish fair value gaps, like there are here, right? There's a fair value gap there, and the fair value gap size does not matter. A fair value gap size does not matter, right? So if there are two overlapping fair value gaps here, if price breaks through this one right here, it doesn't matter. As soon as price breaks through this skinny fair value gap right here, that's when the move is invalidated. Okay, so it's literally the bottom one. Okay, if there are multiple only if there are overlapping fair value gaps. Let's do a change in the state or a market structure shift. We'll do a break of structure first. Hold on. Okay, so break of structure. Let's do. I'll use this for an example. Okay. Structure is right here. Right? What does price do? It breaks the structure right here, right? And then it comes down, retests this, and then goes higher. So it's literally just when when clear structure gets broken. It's just when clear structure gets broken, right? We have structure right here, structure gets broken, and it continues on. A market structure shift is, I saw a good example over here. This is a market structure shift, right? Is when we're forming lower lows and lower highs, but then we form a higher low and a higher high, right? The market structure shift that signals that price is going to go up again is when we have a lower low, right? And then we make a higher high. This is the market structure shift right there. Why? Because it's forming the structure that we're going to use to continue higher, right? Because then price goes up, right? So, we have a low, we have a high, lower high, then we go back here, we have a higher low, which suggests that we're going to continue higher. And what does price do? It forms a market structure shift, right? The body closes above this candle right here, right? And then what does it do? It goes, higher low, higher high, higher low, higher high, right? That's what an uptrend consists of. An uptrend consists of a higher high and a lower high and a lower low, or a higher low. A higher high and a higher low. A downtrend consists of a lower low and a lower high, okay? Right? Assuming this is an uptrend, right? A low, high, higher low, higher high, higher low, higher high, higher low, higher high. A downtrend, right? Price is going down. High, low, higher high, or a lower high, lower low, lower high, lower low, lower high, lower low. Okay? That's what a market structure shift is. A change in the state is, let me find a good one. A change in the state would be like here. Right? Like you could literally say, okay, we rebalanced into this fair value gap right here, right? And we have a change of the state right here. You could take your entry off of this. You take your entry off of this, change in the state, stops a little bit below the low, target this liquidity right here, 1.6 hour trade, and you would have won. So each one kind of means the basis is the same thing, right? Like the market's changing its structure, but it's just whether it's sooner or later, right? So a market structure shift is kind of that first break of structure that confirms the change of market structure. A break of structure is kind of just the continuation of the structure when it breaks, and the change of the state of delivery is like the initial hint, like, hey, we're probably going to move in the opposite direction. So that's what a change in the state is. My friend just texted me. So yeah, that's kind of what everything is. We went over change of the state, market structure shift, break of structure, order blocks, breaker blocks, inverse fair value gaps, liquidity sweeps. That's pretty much everything that you need to know, right? So now is strategy. No strategy is 100% success rate. I will repeat myself. No strategy is 100% success rate. Not even the best trader in the world, which is probably JadeCap, has a 100% success rate. Not even he does. No one in the entire world has a 100% success rate. Okay? Now it's a strategy. I fully recommend either building your own with the concepts that I just gave you and finding out what confluences, which the stuff that I just taught you are confluences, right? Which confluences work for different time frames to help you win trades, and just sit on your butt for hours and hours and hours and hours and look at what the market does and develop your own strategy from scratch. Or find an influence, or find like a trader, a famous trader like TJR, Powell Trades, JadeCap, PB Trades, some of those guys. Look at their strategy, try it out, refine it, and twist it to where it suits you, and use that. That's probably the quickest way. The best probability way to understand it fully is to make your own. If you want to have more confidence in your strategy because of trial and error, make your own strategy from scratch. If you want a faster strategy that can take longer, that if you want, it's hard to explain. If you want your own strategy that's the easiest to do, to look at, and to execute for you, make your own strategy. If you want a strategy that doesn't always make sense to you, but you can sometimes see it, then use another trader strategy and refine it, or just use their complete other strategy, right? Like for me personally, I use PB trade strategy. Why? Because I've twisted on my own. I've tried to make my own strategy, and I haven't. I'm just gonna be honest. Like I haven't been successful with making my own strategy, and that's okay. I have another strategy that I know works, right? Like for example, you know, PB trades. Like I'll try to do it right now. I'm not sure if I'm gonna win. I'm probably not, right? You're not supposed to win in trading. You're not supposed to, right? Which is why you should only be limiting yourself to like 3 trades a day, right? If you win 2, you're done for the day. If you win 1, you lose 1. Then if you win 1, lose 1, then lose 1 again, you're done for the day. If you win 1, lose 1, win 1 again, then you're done for the day. If you lose 2, you're done for the day, right? 3 trades a day max. Limit yourself to max 3% of your position, unless you're on a funded account and you're trying to full port to get that funded as quick as you can. Other than that, 3% max. Max. Right? Is what you're risking. Do not worry about the money. The money will come. I promise you, if you worry about the money, you will not be profitable. I've gotten to a point where I've pretty much stopped caring about the money. I still care about it a little bit, which is why I'm like, you know what I mean? I'm still trying to build my account, but I don't care about it as much, and I've gotten more profitable. So please do not, it doesn't matter about the money right now. You're learning. You don't need, trading is the hardest way to make easy money. That's how I'm going to put it. Trading, the reason why trading is the best business model is because while yes, it requires a lot of time invested and a probability to fail, if you can master it, 1, it's an infinitely scalable skill. 2, you can do it from anywhere, any time in the world, as long as you have internet. 3, it's just a skill that you can use for the rest of your life, right? If they find life on Mars, right, you're not going to be able to drop ship products to Mars. But if you go to Mars and you got internet, you can trade on there. Like, you can literally trade anywhere, anytime with trading. And it's an infinitely scalable skill. There's no cap to how much money you can make off of trading, which is why it's the best, which is why it's the best way, which is why it's the best, hardest way to make easy money, right? Basically, any business is gambling, right? People say, well, you know, trading is gambling. So is any business. You know? You are more likely to fail in any type of business than you are getting a regular job, right? You have a higher % chance of getting a regular job and slaving your life away than you do of starting a successful business, right? 25% of businesses actually last. Less than half. Probably less than 25%, honestly. And you're telling me that trading is gambling. So is dropshipping. So is Amazon FBA. So is OFM. So is freaking Amazon affiliate. It's all gambling. It really is. Why? Because you're investing your money into ads or product or, you know, a program that you use. You're investing money into that, and you don't know if you will succeed. So if your mindset is trading is gambling, so is every other freaking business. So it's just why trading is the best business, because the only way that you can fail is if you quit. You can never fail in trading unless you quit. Literally never. That's why trading is the best model. Right there. With that being said, my personal strategy this is I'm not gonna give you my strategy personally because it's hecka sauce and you can learn it from PB's channel itself, but this is a really good strategy for you if you wanna learn a strategy, okay? So we're on the 5-minute chart, okay? You're gonna wanna wait for New York open. So if we go to New York open, let's see what time frame are we at. 3:55. Let's go to the 5-minute. Speed this up a little bit. For me, New York open is 6:30. If you're on Eastern time, it's 9:30. Okay. You're going to want to wait for a 5-minute fair value gap. This is a great, again, great freaking model. Okay. If you want to pass a funded account or just get some money pretty quickly, right? Find a fair value gap, right? Then you are going, once we have a fair value gap, go to the 1-minute, right? You can see if we have an SMT, but as soon as a fair value gap gets inversed, you're going. And it should be to the side that you got the fair value gap in, right? Like this gets inversed, right? So does this. But if you target that high, then it's probably not gonna, yeah, it'll stop you out, right? Which is why you want to go in the opposite direction, okay? Because if you do, right, then we have a fair value gap right here. What does it do? Gets inversed, enters short right here, stops at the high or slightly behind the fair value gap, target the liquidity, and you just smacked a trade. You just won that, right? So 5-minute fair value gap, and then go down to the 1-minute, and it's the first fair value gap that gets inversed in the direction that you're going, right? So you don't want to go off the inverse of these fair value gaps. You're going to want to go off the inverse of these. Why? Because an inverse to the downside means that price is probably going to go down, which in this case it does. Again, this doesn't always work, right? Like if we go to the next session, let's go to the next session and see if it works again. Okay. So now we're just looking for the same thing that we did last time, inverse to the downside. Okay. First fair value gap that gets inversed. Right here. Boom. That's where we enter off of. For this one, we can just use top spot the high. Target liquidity. If you can't see liquidity, use the fib tool. Mark out the leg that went high before the move down, right? So this is the move up before the move down, right? So you would use your fib. Move up before the move down. Price goes inside of this area, which if you want my fib settings, then here they are. Take a screenshot. And then yeah, so right, so we can aim for 1 to 2 on this, honestly. Yeah, it doesn't win right here because not every strategy is 100% win rate. But like I said, you have to be okay with losing. As soon as you're okay with losing, you'll instantly become more profitable. That's all I'm going to say. Because once again, as soon as you stop caring about the money and trade what the markets present for you, you will become instantly more profitable. So that's a very good strategy for beginners, just right there. Another good strategy is a liquidity sweep, break of inverse fair value gap, break of structure, or just a singular one. Okay, I'll literally just show you. It's best if you use higher time frames and work your way down with each of these, but it really doesn't matter. Okay, so look, we have this one does not look right. Okay, So look, we have this high beats that high, but this high does not beat that high. So we have an SMT. We also have a liquidity sweep of this right here. Okay. And then what happens? We're waiting for this to get inversed, which it does, right? So we can probably wait for a good retest. Goes down, retests a little bit, going off of here. Again, not sure if this will work because not every strategy is 100% win rate, but in this case, it does, and you just won your trade. So you could do the first strategy that I showed you, which happens at New York Open, or you can do, liquidity sweep or SMT, inverse fair value gap, or break of structure. Doesn't matter. I highly recommend finding a bias on the higher time frame, which bias just means where you think market is going to go for the day. Find a bias and trade in that bias, right? Clearly in a downtrend, down bias. I'm looking to take shorts, which we did, and that's part of the reason why we won, right? We're in an uptrend right now. If I was trading this leg right here, I'd be looking to take longs, and I'd probably win. So that is pretty much everything you need to know. I taught you what prop firms there are. I taught you what live accounts there are. I taught you sessions. I taught you indicators. I taught you confluences. I taught you two strategies. I taught you candles. I'm pretty sure that's everything for like ICT kind of related stuff. I'm gonna go over one other thing really quick, and that is AMD, or the power of 3, or PO3. Okay, right? This is what it is. Ready? It stands for accumulation, manipulation, distribution. Okay. AMD is accumulation. The price is accumulating. It's not really going anywhere, right? It's going sideways. And then it manipulates you to think that, oh, we're going to go long. But really, it manipulates you, and then it distributes. And then you get stopped out and go short, right? That's a bearish example of it. Bullish example. So the price is accumulating right here. Breaks the low, manipulates you into thinking you're going short, and then it just stops you out, and it just goes long, right? Accumulation, manipulation, distribution. That's what the power of 3 is. A lot of traders use that. Okay. So, for example, let me try to find an example of this for you. Okay, so for example, right, we can see all this accumulating, right? You can see all this accumulating. And what does price do? It makes a major break to the downside, right? It manipulates you to think, oh, yeah, go short. And then what does it do? It just skyrockets up. Okay, that's the power of 3. Alright, so, another example, what does price do? It accumulates right here. It's not really going anywhere. And then manipulates you into thinking, oh yeah, go short. We have a break of structure right here, we have an inverse fair value gap, right? We swept, we have equal highs right here. We swept some highs, maybe even. And then what does it do? It just distributes and just goes straight up higher. That's power of 3. Silver bullet model is pretty much just a session sweep, right? So say this is Asia, right? This is Asia session, and then this is New York session. Okay, so say all of this is London or Asia session, or Asia session, right? So what does price do? Price sweeps the low of Asia or London session, right? And then inverses the gap right here. It inverses a gap, whether that's a breaker block, order block, a fair value gap, right? You'd go in off of that inverse, stop behind here, target the highs, and you would win. That's a bullish example. Bearish example is this. Okay, so say all of this is Asia or London session. Okay, what does price do? Then all of this is New York. What does price do? It sweeps the high of Asia or London session, and then it inverses this. You'd go in the short off that, stops above the high, target the previous session lows, and you would win. That's silver bullet. That's what makes a lot of people, that's like the basis for a lot of people. So those are 3 strategies that you can use. I pretty much taught you a lot of stuff. There are advanced stuff, which I'll go over because why not? It's going to be one of those videos. So there are things called top and bottom ticking. Top and bottom ticking is where you catch the very top of the move, right? So it's like if I were to like catch a trade and instead of going, off of this inverse fair value gap and getting in way down here, I would be getting in up here exactly where that tick is with barely any drawdown, and I would have a really, really good risk reward, right? Like a 13.4 R, which is like really anything over like 1.4 is like good RR. But those are also lower win rate, right? If you're top and bottom ticking, most of the time you have a lower win rate, but you have a way higher RR, right? So you take smaller losses. So you take a lot of small losses, and then you have fewer big wins. And a low RR high win rate strategy is what I recommend personally, because you can still make an equal amount of money and you can risk more over time faster. Is when you get in way down here, you have a higher stop, but again, price, you know what I mean? You have a higher win rate, but you have a chance of losing more money. So this is like the base of this is literally finding, like, you mark out a high time frame fair value gap, which I recommend 1 hour and 4 hour fair value gap, right? You mark out a fair value gap, you take the consequent, you take the CE or the OTE, which I went over earlier, right? You set a limit order for there, and then as soon as this candle, as a candle closes, you would set your stop. At first you would have like a 15 to 20 point stop, right? And if you get stopped out, you get stopped out, which, you could have entered off the freaking OTE of this, right? And then you would have a 15 point stop, right? And as soon as this goes, boom, your stop moves to the end of that wick, right? And then you would have just top ticked that whole move. And that is, did it hit that low? No. Did hit this low though. You could target all this. It'd be a 46.79 hour trade and you would have won. So that's what top and bottom ticking is catching the whole move down instead of just part of the move. And the most basic strategy that I can think of is taking the CE or OTE of either a rejection block or a fair value gap and setting limit order, tight stop loss, and going. Right? A rejection block is pretty much, say we're in an uptrend right now, right? Say we're in an uptrend. A rejection block is when you have say this is a bullish candle right here. If the wick was like this long, if the wick is super long, but the candle closes in an up direction following your bias or down direction following your bias, that's what a rejection block is, right? So you can mark out that wick. You can mark out that wick and then trade the CE or OTE of that zone. And a lot of times price will bounce off of those zones and go. Another way you could do is if you have you see how this candle right here, these two candles, this is another thing that I just learned the other day, right? When the close and the open of a bearish and bullish candle are the same, right? Oftentimes what it'll do is it'll tap that zone kind of, and then it'll continue in the opposite direction. And if it doesn't, right, if it taps it, then it's invalid. If it goes through it, then it's valid still. Which, let me go to the 1 hour and try to put this and see if this happens, right? You could also do multiple, the close and then the open of, basically as long as the close and the opens are at the same price, you can trade that, right? So if it's two bearish candles, if it's a bullish and a bearish, or a bearish and a bullish, or a bullish and a bullish, it doesn't matter, right? Like this, the price is the same thing. You can mark out that zone, and that would be a POI, which is a point of interest. Right, so let's see if it taps this. Let's see if it, there's also one right here. Bullish and a bearish, close and the open are at the same price. Right, and what did the price do? It tapped it and then went down and took out this liquidity. Right, you literally could have top ticked this, right? Right here. Stop is behind this wick right here, and then to get this liquidity, that's a 3.8 AR or 2, right? And you could do it that way. Those are key levels. A key level is just where a level where price is likely to bounce off of. That's a key level. So if you can combine that with like a fair value gap or something, then it's insane profitability, right? Like right here, this aligns with a fair value gap, right? So you could probably take a trade right here and it would go up. So that's a strategy. I taught you silver bullet. I taught you 2 other strategies. I taught you that strategy. Please, my top tier advice to you, if you guys start trading, please do not try out 30,000 different strategies and get an information overload. I promise it is not worth it. That's what happened to me, and it didn't end well. So that's advice that I can give you. Stick to watching at most 3 people. At most. Don't be watching like hecka people. Like, don't go watching Justin Merlin, TJR, Powell, Dutch, and freaking FX Alex G. Don't watch all 5 of them and try to use all of their strategies. Stick to 1 or 2 strategies at the most that you know work and that you can use. Please just do it. It'll reward you in long term, in the end term. Let's see. I pretty much taught you everything that I know, and this is stuff that took me a year to learn. Please watch the TJR bootcamp if you did not understand some of this. Rewatch the video, or the part that you don't understand. Please, for the love of me, go watch TJR if you don't understand what I'm saying. If you didn't understand this whole video, I'm sorry for wasting your time. Go watch TJR. TJR explains all of this in the most simple terms. Like, if you don't understand TJR, you're a loaf of bread. I'm sorry, but like, if you don't understand TJR, there's something wrong with you. Please go watch TJR as well, because he's a profitable trader. He knows what he's talking about. If you don't understand me, which you might not understand me, but I think I explained this pretty well. But if you don't understand me, please go watch TJR. He explains it pretty much the same level of easiness as me, if not easier. But yeah, I've pretty much lost my voice. I only had 2 cuts, and that was when my mom came in. And yeah, that's like
I've pretty much went over everything. I went over prop firms, the ups and downs of them, live accounts, the ups and downs of them, why trading is the best business model, confluences, time frame importance, tools. That's pretty much everything that I can think about. If you have any questions or if you're an advanced trader and I missed out on something, please let me know in the comments and I will make a video on it. That's pretty much all I could. I'll teach you guys how to execute a trade really quick, actually. Right. So assuming you have all of this, let me teach you how to execute a trade. So if you're going on TradingView, literally, in order to execute a trade, let me go to the 3 minute. If you want to execute a trade, I would recommend don't even start live trading or funded account trading. For your first 3 months to 6 months, do not trade live money or funded money at all. Use paper trading on TradingView. I don't care what anyone says. Until you are profitable for 3 months on paper trading, do not do live or funded trading. I was profitable for 3 months, which is why I'm live trading. You press trade. Say you want to buy, right? You set your stop loss, right? Do your take profit, right? You go to market, make sure it's on market, and then you click, and then, you set your risk USD, right? So how much you want to risk, and then you press buy, right? And then, assuming you want to reverse your position, you just click that. To close your position, you just click this. You can partial close if you want to. And yeah. And that's pretty much how you do it. Or you can click sell, and then do the same thing I just did, and then just click sell. If you want to set a limit, right? So say you want to trade as soon as, say you want to enter in as soon as the trade reaches the middle of this fair value gap, right? You can go to limit, drag this limit up, press sell, set your stop loss right here, take profit down there, and then click sell. And then you'll have a sell limit. So as soon as price taps this point, you'll be in your position. Same thing with the stop, right? If you want to do a stop right here, you do a buy, right? Which you can't do a buy because this is a buy stop, right? So you would have to sell. Okay, so as soon as price reaches down here, reaches down here, boom, it would enter you in a position. That's how you execute on TradingView. Okay. Okay, so let me show you the difference between market, limit, and stop. Okay, stop is stop buy. So it kind of is what it sounds like, right? If you're buying and you set, right? So say this is where this line is where you entered in, right? A buy stop is right here. So say this is your stop loss, this line right here. This is a buy stop. You stop buying as soon as it hits this point, right? A limit is when, it's a limit of buyings, right? So you would sell, or you can buy. You can buy or sell, but it's the limit of where the price would be. Right? So if you set a limit right here, you could buy or sell. Doesn't matter. And then if you press market, then you're buying it at the live price. So right, if you're pressing market, then you'd be buying it right now, live with the market. That's what each thing kind of means. And yeah, please do not use indicators except for ones that'll help you. Look, I have SMTs, buy side, sell side liquidity. What is envelope? I don't even know what envelope is. Kill zones and sessions, liquidity void detector, macros, which macros are like times where macros are like when big institutions move, right? So if in each hour of a micro aims to take out another micro, right? So say if this is one micro, right here, and then another micro starts, it's going to be looking to take out the high or low of this macro depending on the bias or direction that the market is going. So that's what macro is. If you're trading on a live account, which again, please don't do until you have 3 months profitability plus on paper trading. If you're on a live account, if you want to enter live in the market, you just press the amount that you want to buy. Don't mind this. This is for a challenge. If you want to buy, set how much you want to put in there. Set up your stop loss and take profit, and then press buy or sell. Right? You would press buy. If you want to set a limit, click this arrow. Got a pending. Don't know why I can't do it. There we go. Put it to wherever you want. Buy or sell, right? So if you want to buy it down here or buy it up here, you can do it, or you could sell it down here, up here, and sell it down there too. Yeah. That's how you execute on TradeLocker and TradingView, and that is pretty much everything I have for you. Again, if I missed anything, or you have questions, please let me know in the comments. Other than that, this video was an hour and almost 30 minutes long, so I think I've covered everything that I know, and yeah, I will see you guys in the next video.